What if I told you that right now, sitting in your kitchen, sipping your tea, reading your morning paper, you're quietly bleeding money every single month, and the people taking it from you know full well you don't owe it, not a penny of it. And here's the part that will keep you awake tonight once you really let it sink in. There are 5 specific bills that millions of pensioners across this country are still paying, faithfully, dutifully, month after month, when the law itself says they don't have to. Before I take you through a single one of them, do me one small favor. Hit that like button, tap subscribe, and share this video with someone you love who is over 60. Because by the time we're done, you'll understand exactly why they need to hear this too. And I promise you, they will thank you for it. Now let me clear something up straight away. Because if I don't, half of you will click off within the next 30 seconds. And you'll walk away from money that legally belongs to you. A lot of people watch a video like this and immediately decide it isn't meant for them. If you're comfortable with a decent pension, a paid-off house, and a bit tucked away, you probably think this is one of those videos for people who are struggling, not you. And if you're the opposite, if you're getting through the month on the state pension and watching every pound, you probably think this is one of those clever little tricks for folks with investment portfolios and financial advisors. Not you either. And I'm telling you, gently but firmly, both of you are making a mistake that's costing you real money right now. This list is for every single pensioner watching, regardless of your income, your savings, or the size of your home. On some of these, the biggest gain goes to the pensioner living on very little. On others, it's the well-off retiree who's been quietly overpaying for years without a clue. I'll tell you along the way which is which, so nobody gets to fold their arms and mutter, "This isn't for me." Because here's the ugly truth that nobody in an office ever wants to say out loud. Pensioners at every income level in Britain are being overcharged. The only thing that changes is how. And you might be wondering, if this is all true, why has nobody sat you down and told you? Why hasn't your bank called? Why hasn't the council written? Why hasn't HMRC been in touch? The answer is depressingly simple. Every single organization collecting this money has a quiet little reason not to remind you. Your council will not phone you to say you're owed a discount. The taxman will not send a friendly letter explaining they've taken too much off your pension. The high street accountant charging you £300 to fill in a form will not mention there's a charity down the road that will do the same job for free. Nobody in this system is incentivized to hand your money back, so I'm going to do it for them. I'll take you through all 5, one at a time, in the plainest English I can manage, and then, because I know some of you have built up a little something over the years, I'll give you 3 bonus moves at the end that hardly anyone talks about. Those last 3, on their own, could quietly be worth a small fortune to the right person. There is one idea I need you to hold on to through this whole video because it explains everything else. In this country, being entitled to something and actually having that money in your pocket are 2 entirely different things. Nobody posts you a check. Nobody rings the doorbell. Nobody writes you a warm little note saying, "We noticed, here's what's yours." The whole system is designed so that what belongs to you stays quietly right where it is, in someone else's account, unless you stand up, speak up, and ask for it by name. Let me tell you a little about who I am, so you know I'm not selling you something. I spent most of my working years inside the civil service on the side of the desk where forms get written rather than filled in. I have no product to push, no course to flog, no newsletter waiting for your credit card. And in all those years, I'll tell you the saddest pattern I saw. It was never the people trying to game the system who lost out. It was the quiet, honest ones. The people who paid their bills on time, kept their heads down, and trusted the letters they received. They were the ones handing over money they never owed, year after year, because not one soul had ever told them they could stop. That's the cruelest kind of loss there is, because it's silent. No red envelopes, no warning phone calls, just money slipping quietly out the back door of your bank account every month for a reason. That doesn't exist. So let's put an end to it. 5 bills, then 3 bonus moves. And stay with me right through to the last one, because that final tip quietly costs people the most and is one of the easiest things on this list to fix. Let's start with the biggest and the most urgent, because there may be money owed to you right this second. Not next year, not next month, today. It has to do with the tax that gets taken off when you draw money from your pension. And I need you to really pay attention here, because this catches hundreds of thousands of people every single year, and it hits the well-off retiree just as hard as the pensioner on a modest income. Here's how it works, and you'll recognize it the moment I describe it, because if it's happened to you, it stings. The day you take your first lump out of a defined contribution pension, whether it's a flexible drawdown, a tax-free lump sum, or a chunk to redo the bathroom or help a grandchild with a deposit, your pension provider often doesn't have your proper tax code yet. They can't figure out what you actually owe for the year, so they use what's called an emergency tax code on something known as a month-one basis. And this next bit is the part that makes people's eyes go wide. That emergency code assumes you're going to take the same amount every single month for the entire year. So if you pull out £10,000 once, just once, the computer treats it like you're pulling £10,000 every month. That's $120,000 a year in the system's mind, and suddenly you're taxed as if you've become a higher rate taxpayer or even an additional rate 1 overnight. People withdraw a small sensible sum and watch thousands vanish in tax. Right there on the screen. Tax they simply do not owe. Now who does this hurt? Everybody. This crosses every single income line. The pensioner drawing out £3,000 for a new boiler gets punished the same way as the retiree moving $50,000 around. The system doesn't care about your bank balance. It only cares that the tax code wasn't in place when you pressed the button. So what do? You do not shrug and assume the numbers are right, which is what most decent people do. There's a specific reclaim process built for exactly this situation. HMRC even has different forms, depending on whether you've emptied your pot completely, taken a bit and left the rest, or have no other income at all. You don't need to memorize form numbers, you just need one clear sentence. Tell HMRC, either in writing or on the phone, that you've been taxed on a pension withdrawal using an emergency code and you'd like to reclaim the overpayment. That one sentence sets the whole thing in motion. And here's the part that ought to make you genuinely cross. If you do absolutely nothing, HMRC will eventually sort it out on their own, usually after the tax year ends. Sometimes many months later. Meanwhile, they've been holding your money, interest-free all that time, money that was never theirs to hold. Filing the reclaim yourself turns months of waiting into a few short weeks. Picture Jeffrey, 68 years old. He took $12,000 out of his pension to put a downstairs toilet in the house for his wife, whose knees have gone. The provider taxed him as if he was earning $144,000 a year. He lost almost £4,000 in tax the moment the money hit his account. And like most polite, trusting people, he assumed the computer must be right. It wasn't. One phone call, one form, and the money came back. That's bill number 1. And for some of you watching right now, that money is sitting there waiting to come home. Now let's talk about bill number 2, because it's really the other side of the same coin. It's tax being taken from money that, by the rules, should never have been taxed in the first place. This one's about the tax on your savings interest, and there's a huge amount of confusion around it. Some pensioners believe all their bank interest gets taxed, others believe none. Of it does. Both are wrong. And the truth is exactly where the missing money is hiding. Every basic rate taxpayer in this country has something called the personal savings allowance. For this tax year, that allowance lets you earn £1,000 in interest from ordinary banks and building societies without paying a single penny of tax. If you're a higher rate taxpayer, that allowance is £500. On top of that, there's another rule called the starting rate for savings, which can be worth up to £5,000 a year, and it's aimed at people whose other income is on the low side, which describes an enormous number of pensioners who are living mainly off the state pension. Stack those two together, and a modest income pensioner can be earning a genuinely surprising amount of interest with no tax owed at all. So where does it go wrong? 2 ways, really. First, with interest rates finally waking up after years of being flat, a lot of cautious savers, and pensioners are the most cautious of the lot, have quietly slipped into earning proper interest for the first time in over a decade, and nobody has looked at the tax side of it. Second, and this one really irritates me, HMRC adjusts your tax code to collect tax on your savings interest automatically based on what you earned the year before, which means if your savings dropped or interest rates changed, you might be paying tax right now on interest you're no longer even receiving. Who wins in each corner? If you're on a modest income, there's a very strong chance the correct tax on your savings interest is nothing at all, and you shouldn't have been touched. If you're comfortable with a bit more coming in, I won't pretend it all disappears, but the figure HMRC is basing their calculations on is very likely out of date and probably too high. The fix is exactly the same as before. A calm, firm phone call. Say, I think my tax code is collecting tax on savings interest that falls within my allowances. Could you please review the figures you're using? Banks now report your interest directly to HMRC, so the numbers are sitting right there. It's the way those numbers are being used that goes wrong. Take Pauline, 71. She finally moved her life savings into a fixed rate bond when the rates got decent again. Her tax code quietly shifted to clawback tax on the interest. Nobody ever checked whether her overall income was low enough that the starting rate for savings covered nearly all of it. It did. She'd been overpaying for 2 full years before anyone actually sat down and looked. That's bill number 2. Before I go into bill number 3, I want to pause for a second and ask you something. Because this is the point where I really need your help. If any of this has already saved you money, or made you sit up and think, that gets someone else's money back too. Drop a comment below, 1 word, 1 sentence. Just say hello so more retirees can find this video. That's it. That's the whole ask. Right. On to bill number 3, and this one, once the penny drops, tends to make people genuinely angry. It's your council tax. And I want to be careful here, because both ends of the income scale get told or quietly assumed that this help isn't for them, when very often it absolutely is. There isn't just one form of help. There are 3. And between them, they reach almost every household with a pensioner in it. The first is called council tax reduction, and it's sometimes labeled council tax support. This is the one aimed at people with lower or fixed incomes. Here's the crucial detail almost nobody mentions. The rules for people of pension age are far more generous than the rules for working age people. If your income is low enough, this alone can wipe an enormous chunk off your bill. In some cases, it can bring it all the way down to 0. And there's a detail that catches so many people out. The first £10,000 of your savings is completely ignored in the calculation. People assume that because they have a few thousand tucked away, they don't qualify. They do. They very much do. The second is the single person discount. If you live on your own, and so many older people find themselves living alone after losing a partner, you're entitled to 25% off your council tax. Full stop. It doesn't matter what your income is. It doesn't matter what you have in the bank. It doesn't matter how big your house is. It's purely about how many adults live in the property. And I have met widowed pensioners who kept paying the full bill for years after losing a spouse, simply because not a single person had told them the bill was supposed to drop the moment they were on their own. The third is the one that comfortable homeowners always assume can't possibly apply to them. It's called the severe mental impairment disregard. If someone in the household has been medically certified with a condition like dementia and is receiving a qualifying benefit, they can be completely disregarded for council tax purposes. If they live alone, that bill can drop to 0. There is no income test. It doesn't matter what the house is worth. It doesn't matter what's in the savings account. It's purely about the circumstance. And it is massively underclaimed, because families dealing with something as heartbreaking as dementia rarely stop and think about the council tax bill. Look at how that spread covers everyone. The low-income pensioner gets the income-based reduction. The widow or widower gets the 25% off. The comfortable household coping with a diagnosis gets the disregard that the well-off always assume isn't for them. And here's the sting in the tail. Not one of these is automatic. Your council does not sit at a desk, look at the electoral roll, notice that only one person lives at the address, and quietly apply the single-person discount. You have to ask. And why would they chase you down to give you money back? Because every pound they discount is a pound they don't collect. So make one phone call, ring your local council, or search online for the name of your council, followed by the words, council tax discounts pensioners. Then ask 3 simple questions. What council tax reduction do you offer for people on a low income? Am I currently receiving the single-person discount? Do you have a disregard for severe mental impairment? That single phone call, in my experience, has been worth hundreds of pounds a year to people at every income level, sometimes far more. That's bill number 3. Bill number 4 is a little different because instead of a bill you're overpaying, this one is money you're entitled to receive. And it's so massively underclaimed that it has to be on this list. It's called attendance allowance. And the moment people hear those words, 2 things happen. The comfortable pensioner thinks, that won't be for me, it must be means tested. The modest income pensioner thinks, I'm not disabled, I get around fine. And between those 2 assumptions, well over £1 billion a year in this country goes completely unclaimed. Both assumptions are wrong. Completely wrong. And this is the part I most want to burn into your memory. Attendance allowance is for people over state pension age who need a bit of help looking after themselves because of any kind of physical or mental health condition. 2 things make it absolutely remarkable. First, it is not means tested. It doesn't matter how much you have in the bank. It doesn't matter what your pension is worth. It doesn't matter what your home is worth. None of it is counted. A comfortable retiree with plenty of savings qualifies on the exact same terms as anyone else. Second, this one shocks people, you don't actually have to be receiving any care to qualify. The test is whether you would benefit from help with washing, or dressing, or getting to the loo at night, or getting around the house safely, not whether you have someone actually doing it for you. And here's the bit that surprises even people who've studied this stuff for years. Claiming attendance allowance can quietly switch on other benefits too. It can increase what you get elsewhere. In some cases, it triggers the council tax help we just talked about a moment ago. It does the exact opposite of what people fear. Instead of reducing your other support, it can lift it. Who's it for? Both of you. The modest income pensioner who's been struggling on the stairs and assumed there wasn't anything out there. And the comfortable retiree who could easily afford help, but talked themselves out of money they're completely entitled to. The form is long. I'll be honest with you. It's a big, chunky document, but it's the long form that puts real money into your account every single week, for as long as you need it. And you don't have to fill it in alone. There are charities and Age UK offices all over the country that will sit down with you and walk you through it for free. Let me tell you about Dennis, 80 years old, bad. Hips. Steady enough on his feet in the daytime, but a fall waiting to happen every night on the way to bed. Comfortable pension, house paid off, a bit tucked away. He'd never have dreamed of claiming anything because, in his mind, that sort of thing was for people who needed it. He needed it. He just didn't know that needing help and needing money are two completely separate tests. Once he claimed, it came to well over £100 a week, and it unlocked a council tax reduction he didn't even know existed. That's bill number 4. Bill number 5 is going to feel a bit personal because it's actually the fee you're probably paying to sort all these other bills out. Every single year, a huge number of pensioners with perfectly ordinary financial lives, a state pension, a company pension, a bit of savings interest, maybe a small investment or two, hand over £200 or £300 to a high street accountant to fill in their self-assessment tax return. And a big chunk of those people legally qualify to have that exact same thing done for them by trained, qualified volunteers for absolutely nothing. There are 2 charities in this country built for exactly this purpose. And the first is called Tax Help for Older People. It's aimed at older folks on lower incomes, and they deal every single day with the exact questions retirees have. Pensions, small investment incomes, coding notices, all of it. The second is called Tax Aid, which helps low-income people with tax problems more broadly. Both are entirely free. Neither is trying to sell you anything. And if your affairs are truly simple, HMRC's own online personal tax account lets an awful lot of pensioners handle the whole thing themselves without paying a soul. Now I'll be straight with you, because there's a version of me quietly cutting my own throat here, since plenty of good people make a living doing tax returns. So let me give you the fair line, and it goes both ways. If your affairs are genuinely complicated, if you're selling a business, dealing with rental properties, sorting an inheritance out, then yes, absolutely, pay a proper professional, and they'll be worth every penny. But if you're a retiree with 2 pensions, a bit of interest, and a neat little folder of paperwork, do not assume you have to hand over £300 for what amounts to careful copying of numbers from one page to another. Who's this for? Mostly the modest and middling pensioner. But the principle applies to everyone. Do not pay for complexity you don't actually have. Take Maureen, 74. She'd paid an accounting firm to do her return every single January for 11 years running. Her financial life consisted of a state pension, a small teacher's pension, and interest from an ISA, which isn't even taxable. 11 years. She rang Tax Help for Older People. They looked at her situation in a single afternoon and told her she probably didn't need to file a return at all. 11 years of fees, gone forever. That's bill number 5, and it's one of the easiest on this whole list to act on before the end of the month. Now, I promised you 3 bonus moves, and I'll be completely honest about who they're for. The 5 bills we just went through reach across every income level in Britain. These next 3 are aimed squarely at those of you who've built something up over the years. Some money in an investment account outside of an ISA, a few shares, a bit you give to charity every month. If that description doesn't fit you, don't feel left out. The first 5 had you covered from every angle. But if you have built something over the years, these 3 tips can quietly be worth more than all 5 of the bills we just talked about, combined. And here's the thing. Videos aimed only at low-income pensioners never mention these because their audience can't use them. You can. Quick pause here, because we're heading into the bonus territory now, and this is where it really pays off to have someone with you on the journey. If you're still watching, you're my kind of person, so do me this favor. Tap that subscribe button if you haven't yet, and give this a thumbs up, because it genuinely helps the channel reach more retirees who need this information. That's the last time I'll ask, I promise. Right. The first bonus move is about investments held outside an ISA, shares, funds, that sort of thing, that have gone up in value over time. Every single year, you're allowed to take a slice of that gain, what they call a capital gain, completely tax-free. For this current tax year, that tax-free slice is £3,000. Now, I know it used to be over $12,000 a few years ago, and they've quietly chipped away at it. But that just makes it more precious, not less. Here's the move people miss. That £3,000 allowance does not roll over. It is a use it or lose it deal every year on the 6th of April. So a smart retiree, rather than letting a huge gain build up until they're forced to sell the whole lot in one go and get taxed on the entire mountain, sells a controlled, measured amount each year, taking the gain in slices inside the tax-free allowance, and then often buys the same thing straight back inside an ISA where it never gets taxed again. They call this move bed and ISA. It's one of the quietest, most effective things an ordinary retired investor can do, and hardly anyone talks about it at kitchen tables. The second bonus move flows straight from the first. In those early retirement years, after your salary has stopped but before all your pensions are in full flow, your total income often drops to the lowest point it's been at any moment in your adult life, and your tax position drops right along with it. That, right there, is the golden window where realizing gains and doing your tidying up costs you the absolute least it ever will. Most people drift through those years without ever noticing they're standing inside the cheapest tax room they'll ever be in. And then everything piles up and gets taxed much harder later on when the pensions are in full swing. The move is beautifully simple. Notice the window and do your tidying up inside it on purpose with a plan. The third bonus move is for anyone who gives to charity, even a small amount, and pays tax. When you give under gift aid, the charity claims back the basic rate tax on your donation. That much most people know. But here's the bit that even generous, regular givers have often never been told. If you're a higher rate taxpayer, you personally can reclaim the difference between the basic rate and the higher rate on every single donation you've made. That's real money coming back to you, straight into your bank account. And a huge number of people who are perfectly entitled to it have never claimed it, because no one ever told them their giving came with a second half. There's also a lovely little wrinkle for people whose income has dropped since they retired. You can elect to treat a donation as though you made it in the previous tax year. In tax circles, they call this carrying it back. That can be enormously useful in a year where your income was higher than it is now. It's one of those small, quiet levers almost nobody pulls, and for the right person, it can be worth a genuinely surprising amount. Let me pull all of this together with one single idea that matters more than every rule I've handed you. In every case we've talked about, from the pension tax on the very first withdrawal, to the council tax discount, to the attendance allowance, to the free tax help, to those three quiet bonus moves, the rules already say you qualify, or you're exempt, or the money is legally owed back to you. The overpaid pension tax is yours. HMRC is just holding it. The savings allowances are written into law. The council tax discounts are sitting right there on your own council's books. Attendance allowance is fully funded and completely indifferent to your bank balance. The free tax help charities are staffed and just waiting for your call. Every single one of them is real, and not one of them is automatic. I want you to picture the tide going out on a beach. When the water pulls back, it doesn't drag everything with it. It leaves things behind on the sand. Coins, shells, treasures, all sorts. Perfectly good, all belonging to somebody. Your money is out there right now, scattered across the sand, but nobody is going to stroll down the beach, pick it up, and hand it back to you. The entire system is designed so that what gets left behind stays left behind, unless you go down there yourself and pick it up. Being entitled to something in this country is worth exactly nothing until you bend down and claim it with your own two hands, and it truly does not matter which end of the beach you happen to be standing on. There's a version of this list overcharging you right now, wherever you are. The low-income pensioner assumes the good stuff is reserved for people with money. The comfortable pensioner assumes the help is only for people who are struggling. And both of them keep paying. That right there is the entire trick. Knowing the rule and knowing that it applies to you wherever you happen to be sitting is the whole game. So here's what I'd ask of you now, and it will cost you absolutely nothing. You now know 5 specific bills you may not be legally required to pay, and 3 bonus moves on top. And more importantly, you now understand that knowing isn't enough. The money stays exactly where it is until you stand up, pick up the phone, and ask for it by name. Please do one small thing for me. Send this video to one person in your life who's over state pension age or getting close to it. A parent, a neighbor, that friend down the street you know is too proud to ask for help. It doesn't matter whether they're getting by on a single state pension or sitting comfortably on a paid-off house. The chances are excellent that they are paying at least one of these bills right now for absolutely no reason on this earth. And one share from you could be worth more to them than any birthday present you'll ever wrap. Stan, 83 years old, watched a video very much like this one because his daughter sent it over on a quiet Sunday afternoon. He made 3 phone calls the following week. Just 3. By the end of the month, he was better off than he'd been in years. He hadn't earned an extra penny. He hadn't changed a single thing about the way he lived his life. He'd simply walked down to the sand and picked up what was already his. And now it's your turn, or your mom's turn, or your neighbor's turn, or that quiet gentleman at the end of the road who never asks for anything. Somebody in your life needs this. Send it to them. Because in a system built to keep quiet, one honest video shared by one caring person is sometimes the only thing standing between a pensioner and the money that already has their name written all over it.